Now, as we move forward, we're going to look at housing. What are some of the existing home sales? How has that shifted, and where is pricing? Because obviously we know it's exploded. So let's look at how much, we've seen some of those increases, and that's going to be some of the bigger components as we go forward, because this is some bigger pieces for inflation, and as well as when you think about travel, because Airbnb has become a stop for people to look at pricing. But some of those homes that were Airbnb ended up getting sold, because why not take advantage of a $200,000 price increase in that area? Well, what am I going to make on this rental over the next 2 years, or can I just lock in now? And that's where we're starting to see some of these adjustments. So this is just going to kick off of looking at purchase rate lock trends in sub-markets. So we look at second homes are starting to slow. Either people have already spent their money, or they don't have the money anymore because they've exhausted that amount of buying. But there's also could be people don't see the benefits, or the deals are gone, so people aren't in a rush to do second homes. Coming down to vacation home in general, also coming down. Now the investor side still remains elevated. People are looking to invest, trying to capture some of that, and it's more on not buying for Airbnb, but buying for rentals, because, trying to capture some of this increase in rents. But if you're buying at an elevated price, then you're going to have an elevated rent. And that's where, again, coming to some of the stickiness in the CPI calculation, and then non-US residents continue to come into the market, trying to take advantage of what they think is going to be a robust growth. Now, when we look at US existing home sales, things have slowed in terms of some of this. Again, slowed is relative, because it's slowed versus estimates, and you're starting to see some seasonal peaks, because typically we start to see an acceleration, and we're just not getting it at this point in time. And inventories are low. And if inventories are low, well, prices explode. So now you have prices, the average median price at $350,000, and you have inventory at 1.23. So people, and we talked about this through what the Michigan Consumer Sentiment Index, and what are they talking about? People think it's a poor time to buy a home, and they're not wrong. Like, there's not a lot of supply, and there's definitely a lot of price increases that they'd rather try to wait on, which is when you start looking at sitting out. Home flips represent the lowest share of sales since at least 2000, because you need to get a value to then invest. So you get an invest in there. So you get this investment, and then once you get this investment, you have to put more money into it. Once you put more money into it, then you have to sell it for a higher price. Well, as prices continue to drive higher, it's harder and harder to find deals in order to do this. So we're starting to see these flips get lower and lower, and we're just not seeing that same type of capacity. So then when we look at the existing home sales, well, at what number? When we look at the change in sales on 1 million plus, they've all increased from 250 to 500 have increased, but the 1 million plus, that's where we've seen the biggest increase, because a lot of these individuals were coming from the urban to suburban. They had excess cash, and when you look at the credit rating, they were 760 or better, so they were near perfect credit, and they had cash to put down, because many people were still putting down 20% or more. So this is what we think is going to normalize, where that 250 to 500 is going to continue to go up. There's very few houses left in the 100 to 250 level, which we talked about previously. So here's where we think that the 1 million side is going to slow, because the next incremental buyer is going to be harder to find at 1 million plus. But at 250, 500, that's where it's a bit more doable. But if you look at the average median price at being 350, we're starting to even get to the top end of that range, which again is starting to lead to some of these slowdowns. But these prices are going up, which means that when we think about CPI calculations, there's going to be more of that pressure to the upside. But it's not just homes. When we look at used car sales, so there's a lot of talk on, well, base effect, 1 year, but even on the 2-year side, you still have this increase that started as we got into 2019, 2020, and it continues to be elevated. And this is one of those things that we continue to look at, because there's some pressure that remains on the car side. Now, the reason why it's going to remain problematic is really because a lot of these supply chains have been so disrupted. A lot of companies had to shut down or will have to shut down some of their assembly lines, and this is going to keep some of that capacity out, keeping those prices elevated. But we also had lockdowns which forced that change in spending. And when you look at the change in spending, groceries still remain elevated. People are still eating at home, still trying to have family dinners. There are certain pieces of lifestyles that I think are going to be fairly sticky. But when you look at transport still remains fairly down, even though we've seen an increase in pricing when you talk about gasoline, diesel. So when you look at food away from home, that's going higher. But when you look at medical care, apparel, the one that is going to stay the most is, I think, that food at home, which is a good thing in terms of family values, if you will, but it's also a certain amount of people trying to save money, because we do have that inflation coming through. We do have those increase in prices at the food level, but people are still spending money on their cards. So when you look at Chase card spend with and without gas stations, when you look at gas stations and then ex-gas stations, you can see that there's still a big buying side. But the gas station side has come back up. We've seen some of that increase, but it's not like you could see the delta. So it's one thing to consider where things sit right now and just what that bifurcation is, because we had that increase into June, and we haven't really seen that bigger increase going back to some of that normalcy when you look at where we were on a pre-COVID level, especially given where prices are and where that spending is. Because when you look at card spend, you're spending more, but you're really not getting as much because of that inflation, because of that increase in pricing. So then when we turn it a little bit differently, your U.S. retail sales pre-pandemic from goods to services. So when you look at goods to services, plus 15%, but services ex energy consumption pre-pandemic, we're still 7% down. So you're still seeing this conversion ratio, which I think is going to accelerate, but it's going to offset some of that GDP growth, because as some of it comes down, it's going to just be replaced. It's not like they're both going up. It's one or the other, or a little less of one, a little more of the other. And again, that's going to kind of mitigate some of that underlying value. So then when we look at that house price survey, this is, I think, the biggest, the most important when you look at that urban, which is starting to recover, but those individuals moved into the suburban, moved into the rural, driving up those prices, which again, driving up prices, driving up rents, driving up the underlying cost, keeping that CPI. So we've already seen some of the increase in price on gasoline, on services, on retail. So these are those sticky things that are going to remain, and again, move us from this big inflationary spike into that stagflation movement. And this is giving an idea of kind of where. So housing and construction, manufacturing, surveys, retail and consumption, you can start to see that there's these slowdowns. You had these big increases when you look at just the international trade, income. Now you're starting to see some of this cool off. You're starting to see some of this pullback, which is, again, leading to the government transfers, because once you have this big increase, you then have a little bit of this offsetting decrease, because you're just not getting the same type of stimulus, which is that overhang that we continue to talk about, which is working its way through the system and will be more prevalent in Q3. Now, when you look at the change in retail sales between April and May, it's important to see just furniture, electronics continue to decline, prices continue to go up. Again, consumers rejecting prices, but also spending a little bit differently. Well, building materials and garden equipment, well, we've done that. I have that. I don't need to buy some of these things multiple times. I've built it, I have it, I've planted. But clothing and restaurants continue to go up. But some of these on the left-hand side are going to become a bigger overhang versus what the benefits are. Again, shifting some of that spending and becoming a bit of a headwind when you look at just that general overall economic growth. And then when we really look at that interest rate on excess reserves, as we talk about excessively about the reserve repo, it went up 5 basis points, which brought in a lot of excess capacity. But again, you can see just how far down it went and the start to move up, which also brought in people taking advantage of it. And then the 2020 college graduates have seen a bigger fall off in labor force participation than college grads. So again, looking at the participation rate could very well be higher because a lot of these individuals are not being counted in the same way, because labor force participation rate of recent grads, you're not getting unemployment if you never had a job. So that's where you can start to see some of this disconnect, and individuals may be working, living at home instead of getting a menial job or some of these other jobs. This is where the conundrum gets much worse when you look at, okay, well, COVID 2019, 86%, now 79%. Like the pre-COVID to post-COVID, when you look at 07 to 08, there was really not much change on the labor force, but the labor force continues to fall off. But how is it being calculated? Are we missing something? Is there some caveat within it that needs to be looked at when we're talking about what that participation rate looks like? Now, the CEO hiring plans continues to move higher, but even though they're planning to do so, we're not seeing it actually get carried out, which continues to be kind of this underlying, well, when are we going to start to see some of these movements? When are we going to start to see some of these people come back into the workforce? So then when we look at the small business survey, quality of labor is the biggest issue. And I think this is, I think, the biggest problem that we continue to see, because the quality of labor is that overhang. Because if you know there's other people behind that individual, you're going to continue to hold out for the ideal employee. And that may not exist. And you may have to train that individual, but there's the unwillingness to do that. So quality of labor, then when you look at taxes and government regulation, that's also, what are my taxes going to be? What is the government going to make me do? Is it cheaper to have someone as a 1099 instead of a W-2? These are things that are going to become a bigger focus as companies try to mitigate against some of that price increases. And then when you look at the continuing claims, even though they're coming down, they still remain elevated and are still struggling to get back to normal. When you look at March 14th all the way to now, you can see just how many people remain unemployed. Over 15 million. Again, this is something that is going to become or remain that overhang, which is why CEOs may want to hire, but what is the quality? Well, there's a lot of people. I'm going to wait for the right person. And these are some of these friction points that continue to arise, limiting how quickly we're seeing some of these jobs get filled, limiting the amount of people that are coming back to the workforce, which is, again, going to become this overarching problem that is going to take a long period of time to start to correct itself in general.